Welcome to Everyday Mergers and Acquisitions. Hey everyone, and thanks for tuning in. I'm your host, and today we're diving into the most exciting mergers and acquisitions news shaking up the business world. Whether you're a finance pro, deal junkie, or just curious about what's cooking in the boardrooms, this is your go-to roundup. Let's get into it. 1. Creator economy sees explosive deal activity. We're kicking things off with the creator economy. Yes, the world of influencers, video apps, and monetized platforms. The first half of 2025 saw an absolute surge in deal volume. There were 52 deals announced in just 6 months, marking a 73% increase from the same time last year. And it's not slowing down anytime soon. Private equity is playing a starring role. PSG Equity took a majority stake in Uscreen, an app-building platform for creators, in a deal worth around $150 million. Then you've got Summit Partners putting in $250 million to back Later's acquisition of Mavily, a move that strengthens its grip on influencer commerce. Publicis, the advertising giant, is also getting aggressive, snapping up Captive 8 and BR Media Group to bolster its creator strategy. Expect more acquisitions from them, with over $900 million earmarked for deals. Most of these transactions are happening in North America, while international activity has dipped a bit. But with over 100 deals projected by year-end, this space is red hot and getting hotter. 2. A cross-border drama. Couche Tard and Seven & I. Now let's talk about what could have been, a blockbuster takeover that fizzled out. Canadian convenience store titan Alimentation Couche Tard made a bold move to acquire Japan's Seven & I Holdings, the parent of 7-Eleven, in a deal worth roughly $46 billion. The offer came with a hefty 47% premium, so it definitely caught the market's attention. But the proposal hit a wall. 7 & I's board and founding family resisted engagement. Reports say Couche Tard was granted very limited access, just a couple of brief meetings, hardly enough for due diligence. In the end, the offer was pulled. The shares fell immediately, although they're still trading well above pre-bid levels, suggesting investors may be hungry for change. This story highlights just how tough it is to pull off cross-border deals in Japan, where governance practices, family influence, and cultural dynamics play a major role. It also raises the question, should Couche Tard have gone hostile? That's one for the dealmakers to debate. 3. Reckitt Benckiser sells essential home. Reckitt Benckiser is streamlining. The consumer goods giant has sold a majority stake in its essential home business to private equity firm Advent International in a deal valued up to $4.8 billion, including debt. Here's the interesting part. Reckitt is holding on to a 30% stake and plans to return over $2 billion to shareholders through a special dividend. This move lets Reckitt double down on its core brands. Think Dettol, Lysol, and Nurofen, while shedding non-core divisions. The deal is expected to close by the end of the year. Number 4. Union Pacific eyes Norfolk Southern more. In what could become one of the most transformative transportation deals in recent history, Union Pacific is exploring a potential acquisition of Norfolk Southern. We're talking about a possible $60 to $200 billion transaction that would unite two major freight networks, Union Pacific in the west and Norfolk Southern in the east, creating a coast-to-coast railroad powerhouse. The strategic play here is efficiency. A combined entity could eliminate costly interchanges, especially in choke points like Chicago. There's also executive support from both ends, and the regulatory climate appears cautiously open to such consolidation. But it won't be easy. The Surface Transportation Board, the Department of Justice, unions, and freight customers are all likely to have strong opinions. Norfolk Southern, still recovering from past derailments and executive shakeups, might be vulnerable to a bid, so this is definitely one to watch. Number 5. Coates Group acquires OrthoLite over in the UK. Coates Group has sealed a deal to acquire OrthoLite, a global leader in footwear insole technology. The deal's worth around $770 million, including debt, and is being funded through a combination of debt and fresh equity. For Coates, this is all about scale and synergy. By bringing OrthoLite into the fold, they're creating what they call a super tier 2 supplier in the footwear space, offering everything from threads to insoles. Cost synergies are expected to reach around $20 million annually by 2028, and the acquisition is being pitched as a long-term growth accelerator for both revenue and margin expansion.